It has been a very, very busy month for Rocket Lab. They saw their Electron lift vehicle hit a major milestone, signed their largest launch contract to date, and saw coverage initiation from a not-so-bullish Wall Street analyst. Not only that, but after posting our last video where we compared ourselves to institutional Rocket Lab coverage, we were sent an additional report that we didn't have on hand, as well as a revision to one that we did. So we got a lot of ground to cover in this video, so grab a drink, get comfortable, and let's get into it. My name is Scott. Welcome to the channel. Let's talk Rocket Lab. So first things first, the Electron. On June 20th, Rocket Lab saw their 4th launch of the quarter, 8th launch for the year, and 50th launch overall. Not only is this a major milestone for Rocket Lab, but for the entire launch industry, with Electron taking the crown as the fastest commercially developed rocket to reach 50 launches. This 50th mission was named No Time to Lose, which is a play on words paying homage to the French hometown of the launch customer Kinéis. This mission marks Kinéis' first launch with Rocket Lab, with 4 more planned over the next several months, with the next launch planned to be in September, with the remaining 3 to take place towards the end of this year and early into next year. Moving over to Synspective, Rocket Lab has announced a 10-launch contract with the Japanese satellite data company. These launches are set to take place between 2025 and 2027 and are in addition to the launches that are already on Rocket Lab's manifest. The expected contract value for this 10-launch contract is in the range of $70 to $80 million, or roughly $25 million per year. The effect that this announcement had on Rocket Lab's market cap, however, was notably more. To date, Rocket Lab has launched 4 missions with Synspective, with another 2 scheduled to take place in 2024. For those keeping track, this brings Rocket Lab and Synspective to a total of 16 launches over the course of 7 years. Next up, let's check in on Wall Street. We'll kick things off with an overview of each of these new reports, then move into the key performance indicators, then ultimately, we'll take a look at the price targets for each. So the 2 new reports that we received are from Goldman Sachs and from Roth MKM. We can see that Goldman Sachs' forecast generally goes out to 2026, whereas Roth's goes out generally to 2025. Past that, we had redacted follow-up to include regular EBITDA instead of adjusted, as well as free cash flow. So starting with revenue, we have Goldman Sachs, who is more or less within the mid-range of the group, with Roth a little bit on the low side and unfortunately only going out as far as 2025. For gross profit, we have Goldman Sachs barely visible behind redacted, as they are more or less in parity. For Roth, however, they are on the absolute low end of the scale. For research and development, we have Goldman Sachs, who is pretty much in line with Cantor Fitzgerald, and Roth, who is a little bit high for 2025, but then cuts things off. For SG&A, we have Goldman Sachs, who are more or less within the mid-range, a little bit on the low side, and then Roth, who are definitely on the low side. So putting things together so far, we have Goldman Sachs, again, no surprise, a little bit on the low side, but still within mid-range, and Roth, who seem to be trending in the wrong direction. For net income, we've got Goldman Sachs pretty much exactly where you'd expect them to be, and Roth, who are a little less optimistic than the rest of the group. So for earnings per share, as mentioned in the last video, this slide is going to look very similar to what we just saw with net income, with the variable between the two being the number of shares outstanding, which we'll get to in a moment. Either way, we still see Goldman Sachs mid-range and Roth trailing downward. For EBITDA, you'll notice that Goldman Sachs is leading the pack as far as 2026 goes. Important to mention as well is these are all regular EBITDA, with the exception of Deutsche Bank, which is just peeking out behind Goldman Sachs. For shares outstanding, you'll notice that Goldman Sachs is expecting stagnation for share count, which I think is the wrong way to look at this. And the reason for that is because, well, the shares aren't going to stagnate. They're going to increase over time, as we've seen in the past so far. This is what we alluded to a moment ago in regards to earnings per share. The stock-based compensation, there hasn't been any changes made to this slide since the last video. And the reason is because neither Goldman Sachs or Roth guided for this metric. For capital expenditure, you'll see that Goldman Sachs is on the high side, Cantor kind of being in the middle, and us honestly probably needing to revise upwards. Now, last but not least, we have cash flow with Goldman Sachs in the middle, B of A being the most bearish, redacted way higher than the rest of us, and us right around the middle if we were to extrapolate things forward. So now that we've gone over all the key performance indicators, let's get into the good stuff, the price targets. So starting with B of A securities, they have a $10 price target based on a mix of long-term discounted cash flow scenarios between now and 2025. Their discounted cash flow model factors in a 14% discount rate and assigns a 33% probability to each case being the base, bear, and bull case. Next up, we have Cantor Fitzgerald with the $6 price target, which is found by using a blended 2026 expected enterprise value to revenue and 2026 expected enterprise value to EBITDA relative valuation, split 50-50, with a 1.5x premium then applied. For Deutsche Bank, we have a $10 price target, found by using an 8x for enterprise value to sales for launch and 6x enterprise value to sales for space systems. Now we have Goldman Sachs being the most bearish of the group, with a price target of $4.50. This 12-month price target is derived from targeting a 3.2x for calendar year 2026 expected sales discounted back 2 years at a 12% discount rate. For KeyBank, we have $8, which reflects a 7.5x price to sales on a blended 2024-2025 expectation versus the historical range of 15 to 20x price to sales. Redacted is also at $8, and they use a two-step discounted cash flow valuation, arriving at a 12-month forward equity value of $8 per share with a base case range of $6 to $15. A terminal growth rate of roughly 3% is also leveraged into the discounted cash flow model. For Roth, we have $7. This represents a calendar year 2025 enterprise value to sales multiple of 7x, which is a slight premium versus the overall technology peers' calendar year 2025 average of 5x. Now for retail, for us, we're going to throw a dart at the board and go with $5 for 12 months out. This uses a price to sales premium of 4x compared to the historic average of relative indices of 2.5 to 3.5x. The rationale behind this price target being on the lower end of the scale is until profitability is in clear sight, I have a consideration that the market might try to simplify Rocket Lab into terms of a price to sales company. You'll notice that this is kind of what happened a moment ago, where a lot of them are using more top-line oriented metrics. Now, you can have a company that's making $1 trillion in revenue in sales, but if it costs them $999.999 billion to make that 1 trillion revenue, the market's not going to give a shit. And the reason for that is because the name of the game is bottom line, right? It's the earnings, the free cash flow, the stuff that actually comes back to investors. That's what the market as a whole is after. And sure, you could throw darts at the price to sales board and say, oh, the premium of whatever. Like, the fact of the matter is, it's not until Rocket Lab is profitable, so think 2026, 2027, where the market is really going to open their eyes and be like, oh shit, oh okay, I can use my fancy PE metric on this now. I can use my the price to free cash flow on this now. That's when I think there's going to be a real step change in the valuation of Rocket Lab. So yeah, it's a low price target, $5, but keep in mind, this is short term, right? We're not in this for short term. At least I'm not. Maybe you are. I don't know. I'm not speaking for everybody. I'm speaking for me. $5 1 year out, would not be surprised. But keep in mind, this past week, we saw a contract that would net Rocket Lab $25 million a year increase the market cap by $288 million in a day. So, the market is less rational sometimes than others. And maybe we have a really irrational couple of years. But either way, my mind's on the future. I'm not worried about the next year for Rocket Lab. I'm just quietly accumulating over time and kind of, just happy with how things are going so far. So Either way, I'm curious about your price targets, you, the viewer. I'm curious about your valuation metric, how you arrive at that price target. So be sure to comment below, and also be sure to check out the Patreon. You can view it, you can download it. It is in the description below. This includes price targets that go all the way up to 2030. So think more long-term oriented than what we're going over in this video here today. Worth mentioning as well, the price for the Patreon is set to increase on July 1st. The next update is going to be hefty. It includes new sections that detail the backlog, the concentration by customer, concentration by geography, the Wall Street comparisons that we went over today, updates to the recovery tab, and of course updates to the overall valuation model that will include updated price targets that reflect Q2. So if this is of interest to you, be sure to jump on the early bird pricing. And either way, if you got value from the video, be sure to leave a like, and if you're not subscribed already, be sure to subscribe. So thank you guys for the hangout. I look forward to seeing you in the next one, and I hope you have an awesome day. Peace.